Gold just ripped to record highs, and the crash crowd is already celebrating like it's inevitable. They want you to believe this is the top. They want you to believe 2026 is the year gold gets humbled, crushed, and forgotten. But here's what most people don't understand. Gold doesn't crash because it went up too far. Gold crashes when the world suddenly trusts paper again. One decision, one policy shift, one credibility reset. And if you miss that distinction, you will read the chart perfectly and still lose the trade. Welcome to the Currency Academy by John A.G. Now let's get brutally clear in the first 15 seconds. What happened? Gold surged through 2025 like a runaway train, smashing new highs while the stock market had a nice year and acted like it was the main character. It wasn't. Gold was. And when an asset outperforms almost everything, the entire world starts whispering the same sentence. This has to crash, but has to is not analysis. It's emotion. And emotion is exactly how people get shaken out right before the next leg up. So today we're going to do something most videos won't do. We're not going to stare at candles and pretend we're fortune tellers. We're going to break down the actual mechanics of gold collapses. What triggers them, what doesn't, and what 2026 would need to look like for a real crash to happen. Because the truth is uncomfortable. Gold is not fragile. Gold is a mirror. It reflects confidence. And right now, confidence is the rarest asset on earth. Let's start with where we stand. On a one-year view, gold didn't just rise, it dominated. In 2025, gold climbed roughly 64%. Now compare that to the broad stock market, which rose around 16% in the same period. That gap matters, because it tells you this wasn't some random lucky streak. This was capital making a statement, a migration, a silent vote against the current system. And when you zoom in on that one-year chart, it looks smooth, almost calm. It looks like a steady climb, like something you could get used to. That's the trap. Because when you zoom out, it stops looking calm. It starts looking like a launch. A 30-year view makes the move look dramatic. A 50-year view makes it look like something that shouldn't be allowed. And that's where people start getting nervous. Nothing goes up forever. Gravity exists. Mean reversion is coming. Okay, sounds smart. But the market doesn't care what sounds smart. The market cares what changes the rules. So let's talk about the most famous gold collapse of all time. The 1980 crash. This is the story people love to quote. It's the favorite weapon of every gold bear. They bring it up like a courtroom exhibit. See? Gold went crazy and then it fell 65%. And that part is true. And gold surged through the 1970s, driven by inflation, oil shocks, geopolitical chaos, and collapsing faith in the dollar. By January 1980, gold peaked near $850 per ounce. Then it fell hard. A deep decline, a brutal reset. But here's what people get wrong. Gold didn't collapse because it was too high. Gold collapsed because credibility returned. That's the key. Gold is insurance. It is a vote of no confidence. If the public stops trusting the currency, gold rises. If the public starts trusting the currency again, gold falls. In the late 1970s, inflation was not just high, it was embedded, it was expected, it was feared. The public felt like the dollar was melting, energy prices were surging, purchasing power was collapsing, and markets started to believe policymakers were either unable or unwilling to stop it. That's when gold goes vertical. Not because people want jewelry, because people want escape. And then something happened that almost nobody can replicate today. The system chose pain. Real pain. Interest rates were pushed to extreme levels. Rates climbed toward the 20% zone. Think about that. Not 4%, not 5%, near 20%. That means mortgages that could ruin your life. Borrowing that becomes a punishment, an economy forced to slow down no matter who complains. And here's the detail that matters most. Rates didn't just rise, they rose above inflation. That created positive real yields. And positive real yields are kryptonite to gold. Because if you can hold cash or short-term government debt and actually gain purchasing power, you no longer need gold as protection. Gold is not competing with your neighbor. Gold is competing with real returns. In that era, the system restored trust by doing the one thing politicians hate. It accepted suffering. Recessions hit, unemployment rose, asset prices got hurt. But inflation was broken. And credibility came back. The dollar strengthened as capital flowed back into dollar assets. Foreign investors believed the policy was serious. And when trust returned, gold's job disappeared. So gold fell. Not because it was expensive, because it was no longer needed in the same way. That is the 1980 lesson. Gold collapses when the system proves, through action, that holding currency will preserve value better than holding metal. That is a high bar. Now compare that to today. Tell me where the system choosing pain is hiding. Exactly. Now let's jump to the second big reference point. Another favorite talking point. Gold peaked around $1,920 in 2011 after the financial crisis and waves of money creation. People expected inflation to explode. Gold surged as an insurance policy against monetary chaos. But inflation didn't arrive the way markets predicted. Globalization held prices down. Wages stayed weak. Excess capacity kept a lid on consumer inflation. So the panic narrative faded. Then the system started signaling a return to normal. Emergency policy began to unwind. The dollar strengthened. Stocks recovered. Risk appetite came back, and gold didn't crash overnight. It didn't explode downward in one dramatic day. It bled, slowly, relentlessly. By 2015, gold was down roughly 45% from its peak. Again, the reason mattered more than the chart. Gold fell because the insurance felt unnecessary, because the world looked stable enough again. So if you want to understand gold crashes, memorize this. Gold crashes when these three forces align. 1. Real interest rates turn positive and stay there. 2. The dollar enters a sustained strengthening cycle. 3. Confidence in monetary policy is restored. That's it. Not RSI. Not it looks overbought. Not a random red candle. Gold responds to real yields and credibility. Now let's come back to the present. And this is where the story gets spicy. Because people keep comparing today to 1980 and 2011 like history is a copy-paste machine. But when you look at the conditions, the comparison breaks fast. First, real interest rates are not truly positive in the way that matters. Yes, policy rates rose. Yes, we're no longer in the zero-rate fantasy era. But inflation is sticky, not just groceries. Services, housing, insurance, healthcare. The stuff people can't avoid paying. Even when official numbers cool down, the lived reality doesn't feel fixed. And that's the point. Gold doesn't require hyperinflation. Gold only requires that cash quietly fails. That's it. If your money earns 3% and your costs rise faster, you are losing. In real terms, you are being taxed by time. That environment is oxygen for gold. Second, the debt situation is not comparable to earlier eras. Back then, governments could jack up rates and pretend it was just tough love. And today, debt loads change the math. When debt is massive, high rates don't just slow the economy, they threaten the financing of the whole machine. The higher the rates, the more interest expense explodes. And when interest expense explodes, deficits expand. When deficits expand, confidence shrinks. You see the loop? This is why today's system can't easily do the 1980 move, not because they don't want to, because the structure fights back. Third, fiscal discipline is basically a myth right now. Huge deficits have become normal. Spending stays hot even when the economy slows, and persistent deficits are a signal to every smart investor that the currency will be managed over time. Managed usually means debased, not with a dramatic headline, with quiet dilution. Fourth, central bank behavior has changed. This is a monster difference. In past peaks, central banks weren't buying gold like they've been recently. Now they are stacking reserves. They are diversifying. They are reducing overexposure to one currency system. That creates baseline demand that didn't exist in the same way during earlier cycles. It's like an invisible buyer that doesn't panic sell on headlines. And that changes downside dynamics. Fifth, the dollar has competition again, not because some other currency is perfect, but because the world is exploring options. Alternative settlement systems, regional trade blocs, bilateral agreements, diversification of reserves. And the moment the world debates the future role of the dollar, gold benefits. Because gold doesn't need a marketing campaign. Gold just sits there, neutral, waiting. So now we have to address the big, scary question. What would actually cause gold to fall meaningfully in 2026? Not a little dip, not a normal pullback, a real crash. The kind people tweet about like it's the end of the world. Here are the conditions that historically crush gold. Sustained positive real yields, a strengthening dollar trend that lasts, not one good week. Central banks slowing or reversing gold accumulation. Fiscal policy turning disciplined for years. And political willingness to accept prolonged economic pain. That last one is the killer, because credibility restoration isn't free. You pay for it with recession, you pay with unemployment, you pay with anger. So ask yourself honestly, do you see the world volunteering for that? Or do you see the world choosing the path of least resistance? Because the path of least resistance is exactly what gold feeds on. Now, I'm going to be realistic with you. Gold can fall. Of course it can. It is not a straight line. It never was. The smarter question isn't, will gold crash? The smarter question is, what downside is realistic in this environment? And there are only three scenarios that make sense. Scenario 1, consolidation. Gold goes sideways. It burns time, not price. The chart stops exciting people. The hype fades. The weak hands get bored. And that boredom becomes the reset. This is the most common way bull markets continue. They don't crash, they annoy you. Scenario 2, sharp correction inside a bull trend. Gold drops 10%, 15%, maybe even 20% on a narrative shock, a sudden dollar spike, a surprise policy signal, a liquidity event, and it feels horrible. It feels like the end, but it's not the end. It's the market shaking out leverage, then continuing. Bull markets do this. They climb a wall of fear. They punish impatience. Scenario 3, a true bear market. The kind that bleeds for years. This is the one everyone fears. And it would require a policy shift that is basically incompatible with modern politics and modern debt. It would require discipline, pain tolerance, and credibility theater that lasts. Not one speech, not one press conference. Years. So when someone says, gold has to crash in 2026, here's what you should ask them. Which exact mechanism restores paper trust? Where does positive real yield come from? Where does the sustained dollar bull run come from? Where does the fiscal discipline come from? And who is signing up for the pain? Because without those ingredients, you don't get a true crash. You get volatility, you get dips, you get fear. But fear is not a crash. Fear is fuel. And this is where most people make their worst decision. They confuse normal movement with structural reversal. They see red candles and assume the story changed. But the story doesn't change because the chart got ugly. The story changes when the incentives change. And right now the incentives are screaming the same message. Protect purchasing power. Diversify trust. Escape fragility. So what should you actually watch in 2026? Not predictions, signals. Number 1, real yields. If real yields flip deeply positive and stay there, gold faces pressure. If real yields stay weak, gold stays supported. Number 2, the dollar trend. Not one strong day. A sustained cycle. If the dollar runs for months with momentum, gold can correct. If the dollar chops, gold holds. Number 3, central bank behavior. If central banks keep accumulating, that's a floor. If they suddenly slow down, that's a warning. Number 4, fiscal headlines that actually matter. Not talk. Action. Spending cuts. Deficit reduction. Seriousness. If you ever see real discipline, gold has to recalibrate. Number 5, the public mood. This one is underrated. When people feel stable, gold gets ignored. When people feel uncertain, gold gets hunted. Now here's the part where most people are not ready. If gold does correct in 2026, the headlines will be designed to break you. They will tell you the bull run is dead. They will tell you the bubble popped. They will bring out the 1980 chart again like it's the 10 Commandments. They will say, this time is different, while ignoring that this time is different for the opposite reason. And while that noise is happening, the real question will be simple. Did credibility return, or did fear just go on sale? And don't forget, subscribe to support the original work, and if you're part of the movement against copycats, comment John A.G. Best so I can see you. Now I want to hit you with 2 questions, and I want real answers in the comments. First question, if gold drops 15% in 2026, do you see that as a warning or an opportunity? Second question, what do you trust more right now, the long-term discipline of governments or the long-term scarcity of gold? Drop your answer below, because the comments tell me what the crowd is missing. Now let me give you the uncomfortable truth about crash narratives. Crash narratives make people feel smart. They make people feel in control. Because if you call a crash, you get to look like a genius. But most crash callers don't actually want to buy the crash. They just want the ego points. The real winners are the people who understand regimes. What regime are we in? A regime of high trust or a regime of managed decline? Because gold does not need perfection. Gold thrives in imperfection. Gold thrives when the system can't commit to discipline. Gold thrives when the easiest solution is printing, and the easiest solution is almost always printing. So is a crash coming in 2026 a true structural crash? Only if the world flips into a credibility renaissance. Only if real yields rise and stay high. Only if the dollar enters a long bull cycle. Only if fiscal policy becomes disciplined. Only if leaders choose pain over comfort. That's the checklist. And until that checklist starts getting completed in real time, a crash is mostly a story. A fear story, a story designed to shake you out of your position right before the next move. So here's my final message. Gold doesn't fall because it reaches new highs. Gold falls when paper becomes trustworthy again. And trust is not a slogan. Trust is earned through sacrifice. If you don't see the sacrifice, don't assume the trust. Stay sharp. Stay calm. Watch the signals, not the drama. And if you want more deep dives like this, subscribe to the Currency Academy by John A.G. Because we don't chase noise here. We hunt the mechanism behind the move. Take care of yourselves, take care of each other, and I will see you in the next video soon.